One of the ways we find ideas is to look around situations where there's a lot of information's changing, or there's a change in management team, or there's an aggressively sold off share price. So, all those things can lead to a major misperception in the marketplace, not always, but can lead to. So one good example there is Cabcharge, where it was an old monopoly that charged a lot of money for payments in cabs. There's a lot of negative imagery around the company because of previous management team, because they charge a lot of money, and also because of Uber coming through and disrupting the marketplace potentially. Now, Uber's great. I use Uber. I think it's fantastic. Taxis have been very highly regulated, but the coincidence of Uber becoming mainstream in Australia, say over the last 18 months to 2 years, and the regulation on those fares going from, on the taxi payments going from 10 to 5%, has almost perfectly coincided. So Cabcharge earns most of its money from payment systems in cabs. As that got regulated in Victoria, New South Wales, and more recently Queensland, you've seen the earnings come down materially in the back of that regulation change. But that regulation change has coincided with, as I said, Uber coming through. And so I think people have gone, okay, earnings are going down, it must be all due to Uber coming through Australia and smashing up Cabcharge. The reality is most of the earnings hit has come from the fact that regulation change has halved the earnings. At some stage, the earnings base will base out. But fundamental case there is a new CEO, a new board, a new executive team, all put in place in the last 18 months. The fact that a very large part of the earnings and valuation of the company now is in a bus business called CVC, which is a joint venture. That business is worth a minimum of $200 million. Very few people are actually aware that Cabcharge owns half of a bus business, which they could easily sell or dispose of at some stage. Now, if they sold that off, there's a lot of franking credits that they could distribute to shareholders or buy back their own capital, and you get left with a core payments business that's kind of almost based out in terms of earnings at a very low multiple. So we think you've got a lot of misperception around the history of the company, and real opportunity going forward with a new management team, better regulations around the company, and a real misperception around the impact that Uber has had on the company. You just do as much research as you can. So you tick off all the negatives. So is the cash flow real? Is the balance sheet undergeared? Is the valuation attractive? Let's model through what happens to earnings when we assume that the regulation gets rolled out in all the other states. Queensland, for example, is the last major state to regulate from 10 down to 5% on the payment side. And if you model that through and you get a very attractive valuation with all that in, and you see a good rational management team that can actually do something with the core business, you start to figure that actually it's more than priced into the share price, and there's a real opportunity to make money out of it.